All right, good afternoon, everyone, and welcome to the panel discussion on Analysts Take High Conviction Portfolio. I'm Hazel, the Chief Trainer of the Joyful Investors, and I'm the moderator for this panel discussion. So, building a high conviction portfolio allows investors to focus on the investments that they have the most conviction in, highest confidence in, and that could potentially lead to higher returns through thorough research and alignment with their overall strategy. But constructing such a portfolio is not without its challenges. The level of in-depth analysis, together with market volatility as well as economic fluctuations, it may make it a challenge for many investors. So with the expertise and perspectives of our distinguished analysts, we aim to shed light on the strategies to build a more robust portfolio and navigate the current investment landscape in Singapore. Let's welcome our esteemed panelists, Charmaine Tan, Research Analyst, Research and Portfolio Management from IFA Singapore, and John Cheong, Head of Small Mid Cap Research from UOB Kay Hian. Without further ado, let's start off with a round of introduction from our panelists. Over to you, Charmaine and John.
Okay, hi everyone. Thanks Hazel for that. So I'm Charmaine, I'm from IFAS and I cover mainly the Singapore market as well as the real estate. So you can think it's like mainly like REITs, that kind of stuff, and like property development, property developer companies. Yeah.
Hi. Good afternoon to everyone. So my name is John Cheong. I'm the head of small mid cap research and retail research from UOB Kay Hian. I cover the small mid cap space, which include a lot of sub industries such as the manufacturing, healthcare, consumer, and things that are not related to REITs and banks. Yeah.
All right.
Thank
So as we begin, let's first delve into the understanding what it entails to build up a high conviction portfolio. So what is the core investment thesis or philosophy behind a high conviction portfolio? Do you adopt a top-down or bottom-up approach when it comes to picking this high conviction stocks? Let's hear from Charmaine first.
Okay, so to address the first question, so for our core investment thesis or philosophy is actually it revolves around identifying a select number of investments, typically stocks that are deeply researched and believed to have substantial growth potential or are undervalued relative to their intrinsic value. So like using different kind of valuation methods, depending on the sector that this stock is under. And also the emphasis is also on quality over quantity, and that's the meaning of high conviction portfolio, with actually each investment representing a significant portion of the portfolio. And as for the second question, which is on the top down or bottom up approach, essentially we can and we actually uses a combination of both bottom up and top down analysis. So a bottom up approach can focus, you can think of it like we focus on like company specific factors, just like you can see on this slide, like earnings growth potential, competitive advantages, management quality, valuation matrix, and macroeconomic factors on the other hand, and sector analysis, which is more top down, can also be accessed to ensure alignment with broader market dynamics. So on my next slide, you can also see that maybe just through an example, like how we can do this. So for example, let's say CapitaLand Ascender Street. So we look into company specific factors such as like what I pointed out just now, earnings growth potential. So we particularly like their logistics segment in the Singapore and Australia market. So you can think of it as we look into the type of assets that they have and how has the vacancy rate has been going, and also maybe upcoming supply in those areas as well, and also what are other circular tailwinds that's actually driving this space, especially as we all know by now, there's a lot of there's the proliferation of like e-commerce taking over in those space, and Australia actually has one of the lowest vacancy rate for the logistics segment there as well. And as for the tech sector, we know that there has been a lot of high demand for AI, not just across big tech companies, but also different across different countries, like governments that's hoping to adopt AI into their local system. So data centers actually pose a very, very good opportunity as well. So looking at data centers, we also like the those in the flat region. So those kind of factors are what we look at when we try to assess a company such as like CapitaLand Ascendas REIT. And also other things like competitive advantages. Like we know that this REIT is large and well established, is diversified, it has many different kind of asset types. And also we also look into other asset specific things other than the occupancy rate. We also look at whether is it near airport or is it shipping ports or near city center, especially for the logistics segment, because you would want you would think that if a logistic asset is near these kind of areas, it would be more prime for any of their tenants, and also probably they can command higher rental reversions. And as for valuation matrix for CapitaLand Ascendas REIT, for other kind of stocks, we usually use relative valuation, but for a REIT, in this case, we actually look mainly on the dividend discount model, which is DDM in short. Yeah. And as for top-down analysis, we can look at broader market dynamics. And as we all know by now, that REITs actually is an interest rate sensitive sector. So we also do stress tests on it, because now that we know that interest rates are already currently at a much higher than during the COVID days. So this actually will bring about concerns such as cap rate expansion, which will push asset values down and thereby increasing leverage, and also potential near-term refinancing risks, which might compress their interest coverage ratio. Yeah, so we look into all these things and make sure that it's okay. Yeah.
How about for John?
All right. So for to build a high conviction portfolio, we think we got to look at we focus more on the bottom up approach. We think that it is important to look for company that has certain criterias. For example, we look for stocks that are able to deliver earnings growth, and perhaps some stocks with renewed growth angle, such as coming out with new products, winning new customers, new contracts, or major contract wins, or we look at companies that are turning around in terms of the earnings from a loss-making position to a profitability position. And beside that, the second key criteria that we look at are valuation. Look at balance sheet. Companies with strong balance sheet will be able to provide good buffer for shock. PE multiple. Look at PE multiple for the last 2 years and forward 2 years. And dividend yield. Look out for dividend track record. Look out for cash flow generation ability. And look out for management's credibility and willingness to share their earnings as a dividend with shareholder. So of course, also do look out for near-term catalysts when you're picking the stock. Companies with possible earnings or dividend surprises, very undervalued company, or very attractively position company that may be potential takeover target. So these are the three key criteria that we look at on a bottom-up basis. Yeah, on a top-down basis, of course, do follow the industry development of the company, what's happening around the business, around the competitors. This is what we can do in doing extra channel check on picking a stock. Yeah, that's all.
Okay. Okay, so then what about in terms of diversification? So in your view, how do you balance the need for diversification in conviction with the conviction in specific investments? Like, how do you think the portfolio should actually be diversified across the different asset classes, sectors, or even geographic regions? So Charmaine, what are your thoughts on this?
Okay, maybe for asset class first. So a high conviction portfolio would mainly consist of equities, but bonds also actually look quite attractive in the current rates landscape. So we actually have some exposure to that. And as for sectors, we are actually positive on the digital economy sector, which encompasses not just tech companies, but also semiconductor companies. And we actually expect major tech companies to maintain their dominant positions and lead the next wave of growth. And these firms are also actually well positioned to capitalize on the competitive advantages, particularly in AI. Yeah, and we are also positive on the financial sector as we expect rates to remain elevated. So like you can think of like how that will actually impact your higher net interest income. Yeah, then in terms of geography, while high conviction portfolios are actually known for their focus on a limited number of investment, they can also be globally diversified. So like in your SGX market, we have like the example which I shared just now, like CapitaLand and Sanders Street, and as you can see on this slide as well, that it can be globally diversified in that sense. Yeah. So maybe another thing is also how can we then balance the need for diversification with conviction in specific investments. So balancing diversification will actually involves careful consideration of risk tolerance and the level of conviction in each investment. And high conviction stocks may actually dominate the portfolio, but diversification actually ensures that no single investment significantly would impact overall performance negatively. So we will actually look to diversify via different geographical markets and sectors, while at the same time focusing on the quality ones within each market. Yeah.
What about John? What are your views on this?
All right. I don't have any specific slide, but I think for diversification is a must. You got to be thinking about long term in terms of what you want to achieve, but also it also works for different age group. You know, if you are younger, you should have a more aggressive portfolio, more equities versus bond, and as you age, you probably will want more safety, more security, because a person's ability to generate income tends to deteriorate after a certain age level. So that's when you want more safety in your portfolio, and the bonds, fixed income instruments will have to be a bigger part of your portfolio. So, but if you are in the age of within 20 to 40-year-old range, you should have at least like 60-70% equity in your portfolio. Okay, that's all I have to share.
What about geographical regions? Do you have any things to share on this?
I think geographically, don't not really, because you know, a lot of stocks nowadays, they themselves already have a pretty diversified customer base and diversify geographical exposure. So I don't think this should be a major concern or constraints. If you see good companies that have a single customer or two, three customers, you know, for example, some of the manufacturing stocks in Singapore do have one customer or two customers, but they continue to do well over the years. So I think the key focus is more on the valuation and the business quality rather than geographical diversification.
Okay, so moving on, in terms of the risk management of the portfolio, what kind of measures should be put in place to manage the risk within the portfolio? For example, if there are underperforming assets in the portfolio, how would you actually deal with it? What is the kind of time frame that you expect to minimally give for the investment idea to play out? Charmaine, what are your views on this?
Okay, wait, let me address the first questions first. So, what measures should be put in place? I think risk management actually includes like monitoring key financial metrics and market indicators, and yeah, so there can be many things, like such as maybe in the case of a semiconductor company, it can be looking at the non-oil domestic exports of Singapore, like, you know, every month when they disclose the numbers, and also observe the trend and what's actually driving it, and also looking at industrial production, this kind of thing, for like, let's say, a semiconductor company in Singapore. And And also other than that, other than looking just at market indicators, also another important one is also on interest rate, especially if it's heavily impacted by things that are happening in the US, if the company is affected by that. Yeah, and also having a clear exit strategy if the investment thesis no longer holds for such a company. So that's also part of the monitoring process. And another thing is we can also set like concentration limits to ensure that the portfolio is not overly exposed to any single investment and thereby mitigating risk while allowing for conviction in the top picks. And lastly, also rebalancing the portfolio periodically, like quarterly. Yeah. And then for the next one about maintaining and growing a top conviction portfolio in the long term and how do we deal with underperforming assets. So long-term success actually, like what I said just now, it actually involves regularly monitoring each investment performance against its TCs and adjusting position as necessary and potentially adding new high conviction ideas over time to actually grow the portfolio in that sense. And also for the underperforming assets, I guess it will also includes like reassessing the investment TC. So this is also part of the monitoring thing, considering market conditions and making decision based on the portfolio's overall objective and risk tolerance, like what John shared just now, like whether does it still stay in line and or did the portfolio value already deviate over time, such as like not in the kind of weights that you will want for your risk tolerance. And also markets may be irrational at times. So as what we can see over the years. So we invest based on fundamentals. So we will monitor the performance of each holding on a case by case basis against its TCs. And as for the time frame, at iFAST, we are actually long-term investors. So time frame is at least 2 to 3 years. And this is especially so as we invest based on longer-term fundamentals as well as structural drivers, which can take time to, actualize. And yeah.
How about for John? What are your views on this?
Yeah, sorry, can you move to the slide number
Okay.
about 5?
Slide 5.
Yeah, the next one. Yeah. Okay. So these are some of the topics that we have that we want to share, and then I'll bring on some examples to there. So basically, the risk management, how one should do it is to follow the company's development regularly. Look out for announcements, quarterly announcement, earnings release, especially which companies does every quarter or every half yearly. Also do look out for analyst recommendations, analyst reports. When analysts change recommendations, downgrade the stock, especially then got to find out the reason why. Because is it due to a fundamental change of the company or earnings disappointment, and of course what will happen to the future earnings, that's any reason why future expectations have changed. And moving down to the time horizon, we would also recommend typically to take about 1 year, to let the company run its course, for investor to have enough time to monitor the developments. And for example, if you look at Valuetronics, Franken and CSE, Valuetronics and CSE are very good dividend payer. CSE has been paying a very consistent 2.75 cents dividend over the last, I think, more than 5 years. If you buy the stock for dividend, then you gotta make sure that the company continues to maintain the dividend and check out for earnings of the company every quarter or every yearly to make sure that their ability to pay the dividend is there. The same goes for Valuetronics. Valuetronics, I think earlier, Paul from Philips has mentioned as well. Company has about 80% cash, and has been paying out very generous dividend over the years. So also do keep track of the company's earnings, the company's customers profile, the company's new contracts in terms of this customers, which could affect their earnings ability to pay dividend. And of course, on Franken, we know that there are a few major customers like Applied Material and ASML. So these are the major customers that one could track to provide a leading indicator on whether the company will continue to perform well by tracking the major customers. So yeah, that's all I have to share. Thanks.
Thank you. Thank you, John. Okay, so moving on, in terms of the future outlook of the market, right? What are your views on this in terms of the outlook for the overall Singapore stock market, given the current market conditions? Charmaine, what are your views on this?
I think firstly, there's like a broader market outlook also, that actually, US, whatever happened in the US, sometimes it have spillover effects to Singapore as well. So we will also actually look at the broader market dynamics. Yeah, and so firstly, on interest rate, we actually expect no Fed rate cuts this year due to the robust US economy and increasing geopolitical tensions in the Middle East, which could cause supply chain disruption and also drive up costs. And so we expect rates to actually remain higher for longer, and bond yields will actually remain attractive, and also equity valuation are still relatively more expensive compared to fixed income. Then as for looking into Singapore for the tech sector and the digital economy, so you can think of like tech and semiconductor stocks. So I shared earlier about the huge demand for AI. So this can actually potentially result in increased semiconductor application and higher silicon content, and also underpinned by expectation that chip makers will actually experience a structural surge in demand as the world becomes increasingly digitalized. So for Singapore, it actually stands to gain from a promising outlook in the semiconductor sector, which is pivotal actually for its export-driven economy. As we all know that Singapore relies a lot on exports for its overall GDP, and especially electronic exports as well. So we believe that by them actually leveraging on their highly skilled and efficient workforce, Singapore is actually well positioned to become a hub for advanced manufacturing, and it actually plays a crucial role in the global semiconductor industry, particularly in the downstream supply chain involving the testing and packaging of semiconductor products, with a significant 20% share of the global semiconductor equipment market. So for Singapore, GDP-wise, we actually expect it to grow in line with the upturn of the global semiconductor upcycle. And also other like indicators that we have been seeing so far is that, how the Singapore's government attitude towards adopting AI. So we also know that last December, they actually shared an updated national AI strategy. So building upon its initial 2019 launch, which already demonstrated positive impacts across sectors such as education, healthcare, and security. So with this new strategy, it actually aims to triple the country's AI talent pool to 15,000 practitioners and establish a dedicated AI site. So we also see more developments about this strategy during the national budget this year, disclosed in March this year. Yeah. So it actually allocates over SGD 1 billion for AI investments over the next 5 years. And this funding will actually foster talent development, secure access to advanced AI chips, and aid like SMEs with subsidies and consultation in AI adoption across 22 sectors, including food, services, and logistics. So we also see global tech giants. So yeah, we know that Singapore is a key. Many of these large tech giants also set up like their regional headquarters here due to, tax incentives, and like also how safe the country is, and also how Singapore actually acts as a gateway for these large tech giants to actually access the Southeast Asia market as well. So yeah, so we believe this AI demand is likely gonna drive significant growth in semiconductor application. And also, as we all know by now, with the ongoing US-China geopolitical tension, Singapore actually seen increased capital inflow and investment redirection to the region due to its strategic location, transparent legal system, and favorable tax incentive. So these factors will actually collectively position Singapore favorably for continued economic expansion and technological advancement in the coming years. So within SGX, we actually expect certain tech companies like Singtel to benefit, Mapletree Industrial Trust with their DCs located in the US, and also how major part of their contract terms are actually triple net on triple net lease structure as well, which is quite stable, as well as UMS Holdings. And also, we also look into being positive on banks. So sticky inflation has led to a prolonged period of high interest rate, which has benefited large banks like DBS, OCBC, and UOB by supporting their net interest income. So we know that so far, based on their latest earnings, DBS actually achieved the strongest net income growth for about close to 15% year on year, followed by OCBC with growth of about close to 6%. So the high interest rate environment has actually allowed these banks to, maintain elevated NII. And although they are actually facing pressures from NIM compressions, DBS and OCBC have effectively managed deposit costs and leading to continued growth in NII. And also, looking ahead to the second half of 2024, we actually expect the banks to maintain strong performance due to robust economic condition in the US and Singapore, alongside strategy to manage all these NIM pressures through deposit rate reduction and increased demand for wealth management services. And so overall, we maintain a positive outlook on Singapore banks, particularly OCBC and DBS, due to their robust revenue streams, effective cost management, and strong credit metrics. Yeah.
How about for John?
Yeah, can you go back to the fifth slide just now? The
Okay.
same one. Yeah, okay. So for macro outlook, we think investors is very difficult to try to predict too much on the macro because there will always be negative and negative events happening and positive events, but always think about I think more on the bottom-up approach in selecting stocks with good fundamental, good value, and stick to it. Unless there's a very big change in terms of the macro economic side. So I think many famous investors have often quoted that nobody can get the macroeconomic forecast right. So like Charmaine has mentioned just now, semiconductor will be one of the major space that will benefit. So we could look at Franken that has quite a significant semiconductor exposure, and for Valuetronics, they're expected to benefit from heightened trade war as they have built up a new factory in Vietnam. That manufacturing site could benefit from outflow of manufacturing out of China. And for CSC, they are also in the space of building infrastructure for the AI data center and also EV charging stations. And also they will also benefit from the big macro trend of electrification and setting up of more new AI data center. Yeah, so that's all I have to share for now. Thanks.
Thank you, John and Charmaine, for sharing very insightful tips and knowledge on this topic of high conviction portfolio. So unfortunately, in the interest of time, right? So we do not actually have time to take on additional questions, right? But I hope that through this panel discussion that we have today, our attendees, you have been able to gain some valuable insights on the how you can actually go about building up a high conviction portfolio for yourself. Right. So thank you for joining us today, and do stay around for the next session that's coming up next. Thank you.
Thank you.
Thank you. Thank you, Charmaine,
Thank
John,
you.
and Hazel for the insightful sessions. Next, we will have our second company spotlight with Albert Tang and Richard Chan from ISO Team Limited. To watch the discussion, head over to the program tab on SGGM website and click on the watch live button that is beside the sessions. So if you encounter any issues, you can always refer to the user guide tab on the website for more information. We will see you over at that sessions. Thank you.